OSFI's superintendent. Jeremy Rudin joins us now. Jeremy, good to be able to speak with you on this, because this news obviously came out yesterday, but important to bring all of our viewers and new viewers up to date. You had already lowered that capital requirement for bad loans to 1% going back to March. Give us your rationale for why you made no change yesterday.
Yes, I'd be glad to do that. So we committed, when we rolled out the domestic stability buffer 2 years ago, to look at the level at least twice a year, once in December and once in June. And what we announced yesterday was the result of our analysis that we did in June. And the news, and I think it's good news, is that the regime is working very much as we intended. So we built up the capital requirement for our major banks, the domestic stability buffer, in good times, so it would be available in periods of economic difficulty like the ones that we're going through now. We reduced it, as you pointed out, by 1.25 percentage points. And there's still a 1 percentage point left in the domestic stability buffer. And banks are using this in the way very much as intended. So in a downturn, you have to expect an increase in loan loss provisions. That's really inherent in a downturn. And some of the capital space that we created has gone to increase the provisions. But an appreciable portion has also been allocated to growing the book, the loan book, both to individuals and businesses. And that's very much how the buffer was intended to be used. And so there isn't a reason for us at this point to make any adjustments. I will point out, however, it's very much for market participants who are among your viewers, that the reductions in the capital levels that we've seen in the major banks are very much the system working as we intended, that measured reductions in capital measures in a downturn of this type are appropriate and prudent, and that's the system working as intended. And there may be more such measured reductions in capital ratios in the future if the economy continues to be struggling, and that will still be the appropriate and prudent thing to do.
With respect to the intended consequences of lowering the buffer to 1%, as you say, down 1.25%, to free up $300 billion of potential money that could be loaned to businesses, to what degree has that been satisfied?
Well, if we look at the period between March and April, which I think is the most instructive part, we see that overall bank lending by the major banks rose by about $170 billion. So that's been one of the reasons why capital ratios have declined, because, more assets, lower capital ratio. And so that really does seem to be working as intended.
Thank you for that detail. And just to follow up, in terms of potentially changing capital ratios going forward, at what point will you make that decision? I mean, obviously, we are watching numbers every day, and we're watching COVID cases spike, economic data come out. What do you expect to be your next decision time frame?
Well, I can't put a time frame on it because nobody knows how the economy will evolve. We'll certainly look at it. Every 6 months, for sure, we'll make an announcement. But we, like you, are watching the data every day, and we're prepared to make a change to the domestic stability buffer at any time that it's warranted. As you pointed out, we made the most recent decision before yesterday's decision was in the middle of March, which wasn't part of our cycle. But obviously, the rapidly developing pandemic meant that it was time to act. The things that we'll look at will be the evolution of the economy, and certainly a further significant deterioration in the economic prospects could be a reason to reduce the domestic stability buffer further. But it will also depend a lot on the extent of government support programs, which also have a stabilizing impact, not just on the economy, but on the financial system, and just the evolution of bank balance sheets. What the time frame will be, nobody knows. And I think it's important for us to be cognizant of the fact that this is a very difficult time to forecast the economy, and that we can't have a very fixed plan. We have to adapt to the circumstances that we see.
Understood. I'm curious as well in terms of the bank's balance sheets here in Canada. Tomorrow we're going to get the results from the U.S. bank stress tests. How healthy do you think the Canadian banks are right now?
Well, we have taken a lot of steps since the global financial crisis. And remember, our banking system did very well during the global financial crisis. But we have taken a number of steps to improve both the quality and the quantity of bank capital over that time period. And in addition, specifically for the major banks, we introduced the domestic stability buffer, and we ran it up to 2.25%, which gave us one of the largest countercyclical buffers in bank capital around the world. Bank capital levels are now well above the current level of the domestic stability buffer, and so all of that, I think, is reassuring.
What do you make then or say to viewers who hear that, but then also recognize that Laurentian Bank cut their dividend?
It can certainly be, in some circumstances, a prudent and appropriate thing for a bank to shore up its capital. It might do it by reducing distributions, including cutting a dividend. It can be done by suspending share buybacks. It can be done by issuing new capital. There's a variety of ways that banks can shore up their capital, and there's a variety of circumstances that a bank or indeed an insurance company might feel that it's an appropriate thing for them to do. I can comment on any individual institution, as you'll understand, but it's not an unknown part of the Canadian system for a financial institution to decide to shore up its capital through one of those means.
Do you think then that we will see more financial institutions shoring up capital, regardless of in which format?
Well, I think a lot of this depends on the macroeconomic environment. And I trained as a macroeconomist. I used to work as a macroeconomist, so I can say the following. Macroeconomic forecasters have a long history of being fond of saying, oh, now is a particularly difficult time to forecast the economy. And a lot of the times, I think it's just creating an excuse in case they're wrong. But in this case, it's true. It's a very difficult time, a particularly difficult time to forecast the evolution of the economy. And much of what goes on in the financial system will depend on the evolution of the economy. And what's important for us as the regulator and for institutions is not to be complacent, not to be overconfident about our ability to forecast, and to be prepared for the severe but plausible scenarios that might take place.
Understood. Jeremy, thank you very much for being with us. Appreciate your time.